Now, in this lesson, we begin our discussion of the correction for the test that you guys just did. I have to assure you this is a very little time. This term, third term, is a very little time. And so even then, we still have to go through the work that we guys did last term. We see where we went wrong. We have a discussion of it. We correct it so that you are good to go for the items of this term. Now, I will be sharing with you the question paper so that in case you don't have a copy with you right there, it's easy for us to get started. So I'm sharing with you right away a copy of the question before we can get started with the discussion. So yes, your paper was on the 3rd, 2 hours and 100 marks. Now the thing here is, in question 1, we are attempting all the questions. In question 1 specifically, we are required to do what? We are required to explain what these investment terms mean. What these terms mean. These are terms used in investment. Investment is when you get some capital, when you get your resources, could be money, could be human resource, could be something you put into some production or into some productive activity, then you expect some income out of it. Now, what are these terms supposed to mean? The first term here being what? Being the interest rate. What is the meaning of the word interest rate? Then the second term will be investment term or the life or investment life or monthly payment and the principal. So we will be moving right away into the what? Into the correction page. So there, let's go. So the first term being the interest rate. Now, what happens normally is when you give out some money, when you invest some money, when you get some money and you put it somewhere, say in a fixed deposit account, or you give it to a friend, so that after some time your friend will pay back that money with some interest, then you have got to tell them the rate at which you will be charging the interest, okay? Interest rate is not specifically the same as interest. Interest is the excess, okay? The excess on the amount of money that you gave someone. Suppose that you have given them 500 Rand and they are returning 700. The excess is 200. And so that excess is what we call the interest. That interest is determined through what we call the interest rate. You will tell them that this month or every month you will be paying this as the rate or the interest rate. Okay, so interest rate is the rate at which the amount of money that is invested increases in value, and it is expressed as a percentage and compounded monthly or quarterly or yearly. So for example, you have invested some amount of money, well, that's fine. Then now that amount of money you have invested in some activity will be increasing in value. The rate at which that money will increase in value is what we call the interest rate. And obviously it will increase. So suppose that you had some money right here. Now this money that you had, you put it somewhere, fixed deposit account, or you bought some land, or you bought some property, and you're planning to sell it after some time. Let's say you've bought some house, okay? Let's say you've bought a really nice house. Now, because you have bought this house, the thing here is you will want what? You will want to maybe sell it after some time. Now, this really nice house, this 5-bedroom house with a swimming pool behind it right there, after some time it will increase in value. The rate at which it will increase in value, let's say you have bought it at say 800,000, and now after some period of time, let's say a year or 2 years, you're selling it at 1 million. runs, it will have gained up to 200,000. The rate at which it has regained up to that 200,000 is what we call the interest rate. So in very specific terms, interest rate refers to the amount of money that is invested. Okay, the rate at which the amount of money invested increases in value is what we call the interest rate. Interest rate is expressed as a percentage, and it is either compounded monthly or quarterly. Monthly means every month, quarterly means every what? Every after 3 months, and yearly means every after 1 year. The next thing is called the investment term. Investment term means the amount of time that a person commits to an investment. Let's say you have acquired an asset and you're planning to sell this asset after 2 years. The 2 years time period is what we call the investment term, because this is the time that you have committed yourself that beyond this time, the deal is done. At least you're moving on to a new investment. And so this is called investment term or the investment life. The next thing is called the monthly installment, rather the monthly payment, not sometimes referred to as the monthly installment. Now, the amount of money that a person must pay every month into their investment is what we call the monthly payment. And this monthly payment depends on the type of investment you are looking at. Suppose that you're looking at what? Suppose that you're looking at insurance, like life insurance. Then, because you're looking at life insurance, that is, you would like to have your life insured. You will be paying some money every month to the insurance company so that after, say, leaving that job you're doing, the insurance company will take on the responsibility of paying you every month over a period of time. So this is what we call, okay? This is what we call the monthly payment. The monthly payment is the payment that you make. You personally commit yourself to paying into your investment. Your investment can be, well, they can either pay you at once when you are done with your job, or they can pay you monthly or quarterly or even yearly. That is what we call principal, the amount of money that you invest initially. Now, one thing we have seen is with investment, you put in some amount of money, then you expect that it will increase in value. The rate at which it will increase in value we had already seen is called the interest rate. Here it's denoted by what? By letter I. In the first formula, this first formula is used when we are calculating interest rate, and the interest is described as simple interest. But if the interest is described as compound interest, then this is the formula that we use. And from it, we can extract I, which is the interest rate for compound interest. Now, for this formula, P is called the principal. You invest your money. The money you have invested is what we call the principal. The amount of money that you will get after some period of time is what we call A, the amount accumulated after some period of time. That period of time is denoted by letter N. So that is how we describe principal. The next term, or the terms that then comes later, is what? Is the terms we're having in the second question. In the second question, we have terms like a borrower, someone who is taking the loan, okay? Someone who is borrowing the money. The money does not necessarily have to be borrowed from the bank. It can be borrowed from a friend or, from some other institution. You could borrow money from your what? From your employer. So you are a borrower. You could borrow money from some small, some small investment group. like cash round or something like that, you become a borrower. Deposit is that sum payable at first installment on purchasing something as a bond or as a pledge or for a contract, or the balance being payable later. Well, now when we talk of deposit, think of it this way. You went to buy some phone, or you wanted to buy a TV, or you wanted to buy a car. Now, because you don't have cash for this phone or for the TV or for the car, you make an arrangement. You sign a contract which allows you to pay some money. The first installment that you pay for this product that you want to buy or that you will eventually buy is called the first installment known as the deposit. So if this phone is costing 15,000 and you're first paying 3,000, then the other money you keep paying, say monthly, then the 3,000 is known as the deposit. If this TV is costing 10,000, then this TV can be paid for in installment, meaning the first installment is called the deposit. If this car is costing 200,000, then you may be required to pay 10,000. Then the remaining amount of money you pay monthly over a period of what? Say 5 years or 10 years. The 10,000 you have paid as the first installment is called the deposit. It also works even if you're acquiring a heavy item like a house of this nature. The next thing we want to look at is what we call the loan term. That amount of time it will take a person to pay off the loan, almost closely related to the what? To the investment term. Investment is when you're carrying on, when you are starting a project which will earn you some income. An activity that will earn you an income and you put money into it. Over a period of 2 years or 5 years, you expect that money plus the interest. That is called 5 years investment term. But for loan term, it's when you took some loan from someone or from an institution and you're paying maybe after a period of 2 years or 5 years. That is called the loan life or the loan term. The next thing is called the lender. The lender is the person who is giving out the money, or the institution which is giving out the money, which is lending out the money or the loan. There is also what we call the real cost, which is the principal loan amount plus all the interest payable on the loan. That is the real or the total cost of a loan. The loan taken, 500,000 plus the interest, giving a total of like 700,000. So the whole thing, which is 500 plus 200 for the interest, adding together to give you 700,000 is what we call the real cost or the total cost of a loan. The interest rate is the same as what we have just discussed, the rate at which a person is charged for loaning money, expressed as a percentage. Then lastly, what we call the residual. Now, when we talk of the residual, this is also called the balloon payment, and it is part of a loan that is owed after loan term, collected as a lump sum. So think of it this way. You agreed that this is the amount of money you're going to what? You're going to pay to the financial institution. But for some reason, you could not pay it within the time. So that remaining amount, which is paid after the loan period, is what we call the residual. And that is where our lesson of today ends. Until next time,